Hi everyone. In this video, I'm going to walk you through the role that stockholders play in corporate financing. So the primary role that stockholders play for really any public company is providing capital or providing investment into the company that the company can then use for its operations. So it starts off with the investors, right? The future stockholders, who then give capital to the corporation in exchange for some stock that could be common stock or preferred stock. That capital that they give to the corporation, that is typically referred to as paid-in capital or additional paid-in capital. Now, the main distinguishing feature there is if the stock that is being distributed to the investors has some sort of intrinsic value, either what's known as a par value or a stated value, any funds received from investors associated with that are your paid-in capital. Any funds on top of that investors give you, because stocks are traded in the open market and therefore subject to market forces, that's what's known as the additional paid-in capital. Either way, it's still just money that the company can use for its operations. So, as I said, the company then takes that capital, they put it into their operations. Assuming you have successful operations, those operations will then generate earnings. And from there, a company has two choices. A company can keep those earnings inside of the business in order to fund future operations. That's what's known as retained earnings, right? The earnings of the company that have been retained to fund future operations, which then fund future earnings, which then fund more operations, which then fund more earnings, and it just keeps going in that cycle. Or if the company feels that they can, or if they are otherwise obligated to, they could give some of those earnings back to the investors in the form of a dividend, while still retaining other earnings for their operations. And round the cycle goes. Now, stockholders, they aren't just on the hook for potentially getting a share of earnings, whether in the form of dividends or through selling their stock at a higher price than what they bought into it for. Stockholders also get some other rights as part of being owners of the company. And so specifically, if you are a holder of what's known as common stock, you will typically have voting rights on large company matters, such as who serves on the board of directors, should they merge or acquire a certain target, so forth and so on. So your proportional stake of ownership will give you a proportional share of the vote, basically, on those major issues. Your share of stock will also give you a proportional stake in the dividends that the company gives out. So on that prior slide where I showed the dividends going back to the shareholders, you will get your proportion of that based on how much of the overall stock that you own. You also get a residual claim to the liquidated assets of the company should the company end up going out of business. Now, this one right here, I'm going to put a kind of an asterisk next to it, mainly because common stockholders are kind of bottom of the barrel in their claims to liquidated assets. If a company is in trouble and a company goes out of business, it's going to have to pay off its senior debt holders, it's going to pay off its lesser debt holders, it's going to pay off its preferred stockholders, and then if there's anything left after that, it's going to pay off the common stockholders with whatever comes out of the liquidation of the company. However, think about it. If the company has that much money to go around, the company probably wouldn't be failing, right? So what ends up happening is those senior debt holders get paid, and down the ladder you go. But by the time you get to those common stockholders, there's usually not a lot left. And so even though this is a right of common stockholders to get this liquidated claim, frankly, they probably don't get much most of the time. So that's why I'm gonna asterisk that one. If you're a preferred stockholder, your arrangement is a little bit different. You probably don't have voting rights. So that's one of the biggest differences, right? With a common stockholder, you get to vote on important matters. With a preferred stockholder, often you don't get to vote on important matters. However, here's the big difference, or I say here's the big benefit. You get a guaranteed dividend amount. So preferred stockholders, their preferred stock actually states a return on it, such as a 1% return or a 2% return, something of that nature, that actually obligates the company to pay them that dividend. And there are nuances that go into those dividends that I won't cover here. But that's a big difference from the common stockholders who really only get a dividend if the company chooses to give a dividend. Now, speaking of those dividends, if the company does choose to give one out, the preferred stockholders have priority access. So they get paid first. Then any leftovers will go to the common stockholders. And as I mentioned before, they have a priority claim on the liquidated assets of the company should the company go out of business. So they are a notch above the common stockholders in their placement of claims. Now, with that said, those are kind of your two main classifications of stockholders, your common or your preferred. There are also some other rights that may be granted because you were either an early stockholder, you bought into the company in its infancy, or because you're a very large stockholder. In other words, you have a lot of influence there. And those are typically preemptive rights to purchase. Basically, what these are is, should the company decide to go back to investors at a later date and raise more money, if you're an early stockholder or a large stockholder, you probably have the right to purchase first. So in other words, before your stake gets diluted, you could choose to buy enough to maintain the stake you currently have in the company before it goes out to the general public. So there you have it. That's just kind of the roles that stockholders play. They essentially provide financing to the company, but they do get some stuff in returns, whether that's dividends or earnings on their stock gaining value, or whether that's the ability to exercise influence through their voting rights. They do get something back for putting these investments into the company. So anyway, I hope you found that helpful, and I hope you join me for another video.